Hello everybody. So today another quick video about HIMS. I added more to HIMS even though I already have a full position. I added to HIMS under $14. What I want to talk about first is the fact that the stocks kind of all fell in unison together, and of course the small cap stocks fell much more than the big cap stocks, and this is kind of why we see a lot of deals. HIMS was a deal today, but many other stocks were also cheap. A chief reason as to why stocks fell, of course, is, as always, the market's narrative. It's a single issue market, as I like to call it. It only cares about the interest rates. I think it just creates buying opportunities for us. So now it's not June. Now it seems like it's gonna be July, but it could be September. So as I've said before, for the rate cuts, right? Any rate cut we don't get in 24, we'll get in 25. The rate cuts are coming, right? There's no way the government is going to go through is going to start a collapse of the economy by keeping interest rates this high. If you keep interest rates this high, banks go out of business. Major businesses, maybe 30 to 40% of S&P 500 goes out of business because all of these companies have a bunch of debt that needs to be rolled over, and the debt cannot be rolled over at 5%. If it's rolled over at 5%, it's out of business. That's it. It's as simple as that. They will drop, but whatever drop we don't get today, we'll get in 25. And that means if we just get 2 rate cuts this year or 1 rate cut, that means we're going to get a hell of a bunch of rate cuts in 25. So really, if you're a long-term investor, that should not spook you too much. But of course, JP Morgan spooked the market today, down 6%. Because they said, oh, well, we're not going to make as much money. We're not going to be able to lend as much because interest rates are going to stay high. So I've already said that, but the stock that has nothing to do with interest rates that I want to talk about today is HIMS. So as you know, I invest in consumer stocks on this channel. This is a part of the many areas I invest in. And my favorite quote-unquote consumer stock, and it's a hybrid in between a direct-to-consumer stock, a disruption of pharmacy, and a healthcare stock. My favorite right here is Hims and Hers Health. I love Hims under $14. Remember, this is not the same company that we were buying a year ago when it was trading at 7 and when it was not profitable. This is now a profitable company. The market has begun to understand a little more for this company. But this company is also growing faster than we thought it did. And a lot of the fears surrounding the marketing expense have been abated over the past Q4 that we saw, and that result very promising. So that's why we pay a little more for the stock. But I'm fine paying a little more for the stock when I consider how large this stock could get, A, on the one hand, and B, there has to be a valuation reset at this point for this company because it is way too cheap, because this company's revenue is 90+% recurring, and it's way too cheap right now. It's trading like a company about to go out of business, while really, in my view, it should have a multiple closer to a SAAS stocks just because of the nature of its revenue. But anyways, it doesn't really matter because this company has top-line growth. So, of course, the opportunities are there thanks to Mr. Market selling off everything. I've covered multiple times HIMS on the channel. I cover this stock all the time. Today, I just want to discuss why I think this is a secular growth story and not an interest rate story. HIMS is a secular growth story, so you're investing in the underlying business. What is the business? It's the disruption of pharmacy, and it's the disruption of those easy cases that may go see the doctor. HIMS doesn't treat any complicated case, right? It doesn't do any, tough discovery with patients that require face-to-face visit. It doesn't do any of that. HIMS focuses on easy cases, and that's where the bulk of the money is made, because doctors can go quickly through easy cases, and oftentimes you don't even need to have doctors, right? You can have nurse practitioners see those patients. So it's a mix of both easy case doctor and pharmacy, and it's the disruption of both in a single service that has transparent pricing. You know exactly how much it's going to get for both your doctor visit and your prescription. And it is a bundle that includes any follow-up visit with a doctor plus the initial visit, as well as the drug if the doctor deems that you are eligible for the drug. And because of that, they're able to have very clear pricing. They do not accept insurance. Because they do not accept insurance, they're able to move very fast. And HIMSS does not need low interest rates to thrive. And arguably, people buy houses regardless of interest rates, for example. People buy cars because they need a car. You buy a car because maybe your current car is totaled because there was an accident somewhere and you don't have your current car. You need a car today. That's why people buy cars or buy houses, and that's more of an Austrian economics type of thinking. Really, the only thing I agree on high interest rates maybe is for delaying. Maybe high interest rates delay those purchases, but they definitely don't stop them. But there's a belief in mainstream economics that high interest rates are going to hurt the sales of high ticket items right now. Like if interest rates were to stay this high, which I don't think they will, I think they'll go down, but if they were to stay at 5%, people are going to live their lives. At some point they'll say, okay, well, interest rates are higher, they're expensive, and I guess they'll say, oh, I guess I'll pay the interest rate, right? But interest rates are going to drop, A, and then B, really, the stocks dropping, when we see stocks like a Tesla, like an Enphase, stock that I own, like a Lovesac for furniture, and Mr. Market thinking, oh, well, people are not going to buy cars again, people are not going to buy homes again, not going to buy furniture again because interest rates are high. I think that's misguided. It's looking at the world through a lens where people don't have needs and wants, where people's needs and wants are fully mediated by their interest rates. That's one factor. That is not the cheap factor, in my opinion. But the market really shouldn't be punishing HIMSS, because I don't see why the market would ever believe that high interest rates impacts things like when diseases show up and when they get treated, right? That's why healthcare should be recession-proof. The market is not treating the stock like it's recession-proof, but the market, in my view, should view a stock like HIMSS as recession-proof, because here's the thing. When you have, say, sexual health issues like ED, or you have, say, dermatology issues, mental health issues, weight loss needs, you're not going to stop treating those because of high interest rates. And in fact, health, anything that has to do with our health, that's probably the last thing someone will cut out of their budget, right? Because health by nature is very intimate. It impacts us. Health is a chief priority among most people, which is why I think even if this economy, struggles because of the high interest rates and the bankruptcies that are going to come from these interest rates if we keep them this high, I still think the last thing people are going to cut is their ED drugs or their air loss products. To me, that's one of the last things they're going to cut, which is why I love HIMSS. HIMSS is my recession-proof play in my portfolio, and I've just expanded that play in the portfolio. Unlikely to stop their subscriptions. They're unlikely to do that, especially as most of the treatments provided by HIMSS, the average is $54 a month on average, right? That's less than an internet bill. My internet bill is like $80. So $52 a month is less than an internet bill, less than a phone bill. It is low enough for people to get treated and to put it on autopilot, just like you would a Netflix subscription. It's on autopilot. There's no need for people to constantly reassess their expense and to stop their expense. They just set it. They see a doctor. The doctor may or may not prescribe. If prescribed, they just stay on the drug and get their issue addressed. And this is why I love a company like HIMSS. It's recurring revenue. More than 1 million customers HIMSS has paying a monthly fee to get various type of prescription drugs. More than 1 million, and that's growing at a 50% clip. And HIMSS, by the way, and this is why I'm compelled to buy this stock, it's still my cheapest direct-to-consumer stock, aside from Love. And many of you have asked me for a video, by the way, on Love in the comments. I've looked at the earnings report. Yeah, the stock is down 10%, but that's because of a very minor revision in earnings in the upcoming 12 months. And in revenue, the revenue was barely changed, just the range changed slightly. So if you're wondering about Love, by the way, yeah, I don't understand why the stock dropped this much, because the change on love was barely anything. Why do I love HIMS though? Go back to HIMS. The gross margin is excellent at 83%. The gross margin is persistently high, higher than they've guided, higher than they keep guided. Next 12 months, analysts are telling us 41% revenue growth. I think it's going to be closer to 50%. EBITDA margin right now is 5%. I think that's going to go up. This is a company that is profitable, and this is a company that is growing fast. And if you add both revenue growth and EBITDA margin, the rule of 40 gives us to 46. But keep in mind, EBITDA margin over the long run may trend towards 30% as they have guided. And how much am I paying for that growth? How expensive is that growth? Well, I'm paying a 0.09, which is the top 10% cheapest stock in my universe. And to give you an example, say if I compare this stock to Tesla on a growth adjusted basis, HIMS is about 14 times cheaper than a Tesla. I'm not even going to compare it to a SAAS stock like a CrowdStrike, for example. If you do that, you would find this stock is maybe 30 times cheaper on a growth adjusted basis. So to the question, how much am I paying for each percentage point of revenue growth? Here at 41%, how much am I paying for each percentage point? 0.09. It's dirt cheap. It's the cheapest I've seen aside from Love, which is at a 0.82 or 83, I believe. But HIMS, unlike a lot of stocks, they have near-term catalysts. They have important catalysts. One of them is the UK expansion, and they may go into much of Europe coming up. But right now it's the UK they're focusing on. It appears to be doing well. They have ads in the subway over there, and they have ads on TV over there, and it appears to be doing very well, their expansion. And of course it makes sense for a US company to make the UK as its first international destination. You know, same language, similar Anglo-Saxon culture, makes pretty much sense to me. Of course, weight loss is all the rage right now, thanks to social media. Everybody seems to have found a renewed interest in losing weight. It's the season 2, right, being spring. That seems to be doing very well when it comes to HIMS. And HIMS right now, they've only launched a cheaper treatment than GLP-1 drugs. They've launched a inexpensive treatment for weight loss. But there is a strong interest right now for using prescription drugs, pills or injections, in order to lose weight. And this is when this comes back up. So there is a debate, right, in the HIMS community as to whether they're going to offer GLP-1 drugs. Based on listening to the call, it seems to me that they they will offer them. The CEO has talked about offering them. The question is it this upcoming quarter? Is it in Q1 that it will be announced? Is it in Q3, Q4? If you look at the stock like LifeMD, which is a stock I had covered once on the channel before it ran up. If you look at a stock like LifeMD, it's doing very well with these GLP-1 drugs. I anticipate that HIMS could do very well if it offered that, and that could be a catalyst for the stock. And I want to be on the train. I want to be on the stock if this ever gets announced that they offer this. Another thing that I'm waiting for HIMS is, of course, so in the Q4 we got the guidance, and we see this very sandbagged guidance, but still quite high, but sandbagged if you ask me. Although we are waiting for what I really care about, which is the long-term guidance. So this is the end of 2026 guidance, and they had guided more than 1.2 billion in revenue by the beginning of 2026, end of 25. Sorry, is what I meant. 100 million of adjusted EBITDA and 30% long-term EBITDA margin is what they had guided. My view, based on the numbers, based on what I see, it seems like they could reach this a full year early. Like we could find out about this in February of 25. In February 25, if you look at today, right? Today is April of 24. They already have 872 million. So in 4 quarters, it is not that far-fetched to imagine that they'll do 1.2 billion. So this needs to be updated. When this is updated, I think the stock will re-rate as well. And I don't know when it will be updated, but I'm guessing one of these quarters, where Q1 or Q2 of 24, I think is when we may see an update. At worst, the end of this year, I think we'll see an update to the long-term guidance. And when that happens, the stock should also re-rate. The market loves long-term guidance, and I especially love long-term guidance. So To conclude, HIMS under $14 as it closed tonight. I'm loving it. And I'll conclude once again, this is no investment advice, no financial advice. I am just an entertainer. This is just entertainment. I hope you were entertained. Please like, please subscribe. Thank you for watching and have a wonderful day.